So earlier this year, I actually conducted a live stream with my stock market predictions for 2023. So of course, as Asians, we love a good report card where we can bring back to our parents so that they can compare us against our neighbors. But anyhow, I think I just wanted to share some of my observations with regards to this entire prediction game. So I think earlier this year, I actually made 8 bold predictions. And now, as the year has passed, I can confidently say that most of them have actually fall flat on itself. And I think there are a few meaningful things that we can take away from it. So my first prediction is actually that the China will outperform the United States in 2023. I did cite two main catalysts. Firstly, it's regarding the pandemic overhang. Late last year, after the quote-unquote elections, they did say that they're going to lift many of these pandemic restrictions. And secondly, it's of course regarding the revitalization of the Chinese economy again. And we are expecting some sort of monstrous growth coming out from this pandemic overhang. More importantly, because of this entire idea of revenge spending, which you have seen and observed from the rest of the world. But evidently, this whole entire idea of revenge spending, Chinese economy coming back on track, and consumer sentiments turning to the positive, these are just fairy tales that Chinese investors tell themselves. You can see that at least based on last year's market behavior, actually the Hang Seng and even the CSI 300 index, they are air quotes outperforming some of the US major indexes like the S&P 500 and the Nasdaq, which is the QQQ. However, if you were to look at it based on this year's performance alone, the Chinese counterparts continue to stay in the bear market. In fact, there is a delta of as high as 70% because the QQQ is actually up 52% this year to date, while the Hang Seng Index and even the KWEB, it's down 17 to 18%. So if you add them together, that's the huge disparity in terms of how the US versus the Chinese market is performing today. So are we seeing the end of this tunnel? I think it's up for debate. Now, moving on to the second prediction, I said that there wouldn't be a Fed pivot in 2023. So at least based on the start of this year, the consensus target for the FFR, which is the Fed fund rate, is between 5 to 5.25%. You can see that at least based on this dot plot, this is where most of the FOMC officials are predicting. So this was essentially the probability of the Fed fund rate where the market is trying to price in. Most of them actually are saying that, hey, we are going to maintain at around a 4.75 to 5% throughout the entire year, and we might actually see one cut at the end of the year. So at least on this prediction, I think I got a point here. So I think it's true that there wasn't a pivot in 2023, and on top of that, rates are actually higher than the targeted 5 to 5.25. So right now, it's actually at 5.25 to 5.5. However, the future outlook is a lot more optimistic from here, where the current consensus on the targeted Fed fund rate for 2024 is actually between 3.75 to 4%, where they're expecting a 150 basis point cut, which is 6 cuts from here. That said, the dot plot by the FOMC actually shows that their estimates is currently right around 4.5 to 4.75%, which only represents a 75 basis point cut. So of course, we'll leave the crystal balling in the next video where we talk about the outlook. But this, I think based on the fair assessment, I got the point here. So it's 1-1 now. One right, one wrong. Moving on to the third point, where I said that both growth and tech will continue to underperform. My largest argument was really regarding interest rates, where I argued that, hey, if interest rates actually do remain elevated, even though they might not be hiking, it will still act as some sort of gravity to valuations, creating a largely bad environment, specifically for many of these growth and unprofitable tech companies. That said, I was totally wrong. In fact, I was wrong by a very, very large margin, as there was significant outperformance from both growth and tech across the board. And growth stocks were actually not hit badly as expected. And we are currently in this very nice sweet spot where we are experiencing some sort of a Goldilocks scenario where the soft landing was actually engineered by the Federal Reserve. And there wasn't really any big things that essentially break the entire economy. And more specifically, something that I actually didn't account for is that in this high interest rate environment, many of these big tech companies actually benefited greatly because of their huge cash pile, means that they can invest in many of these short-term securities and instruments that allowed them to generate even more income for shareholders. 2 wrong, 1 right now. So, it has been some time since I've joined Webull's Moneybull promotion. So I've transferred 7,000 Singapore dollars into Moneybull back then, and I've since received $32.47 via their money market instrument. So at the time of this recording, the 7-day SGD yield per annum of the SGD cash fund is sitting at a whopping 4.41%. And the best thing, the money is liquid and it's not locked up like a traditional debt-based instrument. On top of that, from the previous campaign sign-up rewards, I will be getting USD 120 cash vouchers when I fund and maintain the amount in the account. But this promotion has since expired. So for those of you who have missed out on the initial promotion, don't worry. Weibo has decided to extend this campaign and have since actually lowered the requirements. It's no longer 7,000 Singapore dollars. You now just need to fund minimally 2,000 US dollars, activate Moneyboo, and maintain your funds throughout the event period. And you can get cash vouchers worth US $80. So for those of you who qualify for the highest tier and deposit more than 100,000 US dollars, you can enjoy the highest reward quantum Weibo has offered to date, which is 3,000 US dollars cash vouchers. So some of you might be wondering, why would you want to use Moneyboo? First, there is a high degree of flexibility where you can actually optimize the utility of your idle cash. And sometimes you just need your money for some unforeseen circumstances, like a market crash. Touch wood, of course, so you can deploy them quickly. Second, Weibo do not charge any fees when you park your money with Moneyboo. Third, they offer rather competitive rates when compared to the other offers in the marketplace today, especially comparing across liquid funds. And last but not least, by taking advantage of their campaign right now, it enables you to supercharge the short-term yield on your money because it's just a crazy good deal right now. On top of that, I also mentioned that they have the invitee-only promotion for new users. So new users who use my link down below to join Weibo today can fund and maintain their account in their Weibo account for 30 days and win 10 fractional shares worth between 30 to 5,000 US dollars. So remember to sign up with the link below now. And I also understand that many of you are seasoned investors in your own rights that uses options to complement your investing portfolio. Right now, you can simulate real options trading on Weibo's in-house platform without any cost. It's basically paper trading, but with options. So most of you will appreciate the intuitive interface and useful features Weibo has to offer when doing your pre-trade options analysis. So for those without a Weibo account today, I don't know what you're waiting for. So many good sign-up rewards and so many platform functions. Sign up with the link below now. Thank you Weibo for sponsoring this video. Next, my fourth prediction is that there's some sort of a bottoming out in second half of 2023. I did say that I was not expecting a V-shaped recovery because what goes up fast will come down fast. However, in 2022, it was essentially a very choppy year and it was just sliding downwards. I definitely did not expect it to just rebound so quickly. Next up, number 5, I did say that Alibaba and Tencent will be big winners because they are essentially proxies to the Chinese market, and I'm expecting a 20 to 30% return year to date. So evidently, I cannot be more wrong than this. Both of them are essentially destroyed this year. Tencent actually did perform a lot better than Alibaba. They are down around 4.7% year to date, while Alibaba continues sliding downwards. So there was some sort of a momentary peak in terms of sentiments in the earlier part of this year due to the entire Chinese reopening story, and the story actually loses its steam and then there was consistently selling across the board. So investors also don't seem convinced with the resolve of the government to step in. So there's no major announcement of stimulus checks or decreasing in interest rate or trying to stimulate the economy, etc. Next, moving on to the China's property crisis. So I think I did make certain claims here, saying that there might be more clarity moving into 2023 and how this entire property crisis is kind of a rigged game where money will be flowing from the left pocket to right pocket and they'll try to sweep things under the carpet, while bad actors will actually be punished. So direct bond or equity holders will also suffer collateral damage. So I think for this specific case, I did highlight this prediction in grey because there really isn't a very clear-cut way of saying that whether I got this right or wrong. I think it's true that many of the bad actors has been punished. Many of them have been jailed, they've been fined, many of them have went bankrupt. A lot of the direct bond and equity holders also suffered a huge drawdown in terms of their position. Of course, if you were to compare that from their all-time lows, I think even Evergrande's equity holders did experience some sort of gain because they were at rock bottom prices. But you get my point. There were many cleanups. So many of the bankruptcy hearings, even for people like Country Garden, it just keeps getting delayed, keeps getting pushed and postponed forward into 2024. There is definitely more clarity compared to 2022, but there is still a huge cloud of uncertainty, which also explains why investors are very skeptical about investing into the Chinese market. So moving on to number 7, I did say that the FANG names will have mixed results. So generally, I think that the tech names wouldn't rush back to 2021 levels valuation so easily. But I did say that I do think names like Meta, Amazon, and Google seems like really good entry opportunities. So I'm not as bullish on Apple, Microsoft, and Netflix due to their relatively higher valuation. So I did color this prediction in grey again, because I did get my first bullet point wrong. Many of them have actually recovered to their 2021 levels. We have to pitch the 5 companies specifically that I talked about: Meta, Amazon, Google, Apple, and Microsoft. Meta, Amazon, and Alphabet, which I have a bullish bias on, actually all 3 of them did kind of outperform Apple and Microsoft. Although you can argue that, hey, Alphabet, it's the same. All 3 of them perform around 55%. But I think for Meta and Amazon, those 2 have significantly outperformed their other big tech, more highly valued counterparts. So I guess this prediction is also in no man's land. I was right, yet at the same time I was wrong. So yeah. And more importantly, especially for my disclosure, I did say that at the time of the live stream, I did have Meta, Amazon, and Google in my portfolio, and it makes up around less than 3% of my exposure. At least for myself, I've actually been adding on the dips, and they are now closer to 13% of my portfolio already. And this is basically the breakdown, and they all now make up a more sizable portion of my portfolio. And on the last prediction number 8, I said that investors will have a rude awakening. At that time, I believe that the projected earnings are still very optimistic, and there will be a slowdown coming in Q1 and Q2. So you can see that at least based on Yardeni's research, the earnings forecast amongst analysts expected Q1 and Q2 of 2023 S&P 500 earnings to only experience a negative 1.4 and a negative 2.5% decrease year on year. However, at least based on the actual data being released thus far, in Q1, S&P 500 earnings was actually down 3.1%, while Q2, they were actually down 5.8%. Compared to the 1.4 and 2.5%, I guess it's true that investors did have a rude awakening where the earnings projection were indeed too optimistic. That said, the market honestly didn't care, and we continued with our market rally. And right now, all the major indexes are up. Dow Jones all-time highs, S&P 500 almost all-time highs, QQQ massive rally in 2023. So I think here are the 2 main takeaways. Firstly, you can see that at least based on my prediction, I did have a bearish bias on the US market when I created this entire slide deck, but clearly I was wrong. But that said, even having a bearish bias, it doesn't mean that I sell off my entire US holdings and I just sit on cash or even short the market. So I think if you actually do adopt a very long time horizon and you are a net accumulator of stocks and businesses over the long term, having a bearish bias is good, having the stock market to crash is good, because it means that you can actually accumulate more shares over the long term. So regardless of whether I was bullish or bearish, I continue to accumulate shares. So this is the first most important point. Regardless of your bias, please be net accumulators of stock. And the second takeaway is this. You might be right on your expectations of certain events happening. Let's take this earnings projection example. I think that they are too optimistic. I think Wall Street is too optimistic. I think analysts are too optimistic. But the funny thing is, even though the expectations of this event was right, I knew that earnings are going to come in softer, but the reaction of the market was totally the opposite. They didn't care whether earnings came in softer. People just continue bidded many of these valuations up. So knowing the event is one thing, the reaction of the market participants is another. Don't conflate them together. So feel free to leave in the comment section down below of what your outlook is for 2024. And with that, I'll see you guys in the next video, but more importantly, I will see you on the moon. Goodbye.